Good afternoon, and welcome to this session, and welcome for taking the time. And do approach, because if you were thinking that this would be a nice session for a short nap after lunch, you are so mistaken, because we're here to pick your brains. So please approach so that we can have an interactive discussion during this session. The title of the session, as you can see, is Digitalization of Microfinance, Emerging Practices and Their Beneficiaries. And over the last 2 days, I've had the pleasure of listening to so many great panels and discussions, and we've talked about digitalization or digitization, which I usually use for automation of analog processes, or digitalization for introducing new digital business models. Maybe a finer point of distinction, but it makes a difference anyway. We want to talk about financial service providers in a broad sentence, not only microfinance institutions, but of course microfinance is the focus of this conference, so that's where we start out. And we want to talk about how the introduction of digital is not only something that set high hopes for the future for access, but is also something that is changing practices in complicated cultures and complex cultures. So the format for this session is going to be a brief presentation from my three ladies here. So I would call you discussants or presenters rather than panelists, because it's not going to be centered all around you, but mostly about the stories and experiences that you can share from the audience that we want to learn from, about how you see practices changing with digital arriving. So, I mean, I don't know what's wrong with the first row, but if you want to come forward, that would be great. Then I don't have to run through the whole room every time everyone's want to ask, somebody want to make a comment or something. But that is what we're going to do. So we're going to have 3 short presentations mentioning where the speakers will present themselves and talk about their backgrounds, and also present a nice question that they would like to discuss. And then we will run a session of discussions and comments where we can hear your stories and you can share your experiences. And towards the end, we will invite you to take up any subjects that we did not touch upon that we forgot, because probably we did forget something or we're not able to include everything. And I should start also by saying that I'm so sorry for not being more gender diverse here. But then it's maybe excusable since it's an all-female panel, and you will love them, I can tell you that. So I think that before we start, we'd like to get you working now that you're sitting comfortably. And if I could ask anybody who is an academic to stand up. Ooh, there are a few, that's nice, thank you. And then anybody who's from a financial service provider. Oh, that's good, we have some of you as well. And I should say, if you're able, because I don't want to make people uncomfortable standing up if you just got seated so well. So what should I say, anybody from an NGO? Oh, yes, it's good. Anybody government? No. But then we have a nice array of different perspectives, and I look forward to inviting you to comment as we move on. So I think that without further ado, I'll move to the 3 presentations. So we'll have 3 presentations in a row, and then we'll go back to the discussion, and towards the end we will have anything that we didn't touch upon, and I'll summarize a little bit. So I'd like to invite the first presenter, Erin Taylor, to start with presenting yourself and your comments.
Sure, thank you very much, Annette, and thank you. It's so great to see you all here. My name is Erin Taylor. Along with Annette, I'm the co-founder of Finthropology, which is a small research company that specialises into insights into people's financial behaviour. And the word Finthropology is an amalgamation of course, finance and anthropology. So we take a human-centred approach to trying to find things out about people. A lot of what we do is qualitative because of the anthropological angle, but we also engage in mixed methods research as well. So it's a bit of the 2 things. The biggest project we're doing right now is a collaboration with 4 universities, 2 of which are based in Australia. And it is a project that is 5 years long, in which we're looking at the impact of digital financial services on smallholder farmers. And that is involving sort of a global kind of approach to an SLR plus fieldwork in Laos and Cambodia. So why this matters is because, of course, we're looking at the practices around digital and digital finance. And it's been a very interesting process so far. We're a couple of years in. And one thing we did, which really inspired this workshop today, was we did a systematic literature review of the global evidence for the impact of digital financial services on rural people, with a particular emphasis on smallholder farmers. And that process was extremely interesting because of what we learned and also what we didn't learn. So digital financial services are not new. Mobile money, for example, has been around for a very long time, and of course in many countries there was online banking for long before that. However, as you're probably aware, most of the literature, most of the evidence for impact is focused on financial services more broadly and not specifically on how the digital might change things. And some of the findings have been quite fascinating. First, most of the evidence is for mobile money. Most of the evidence is for Africa and not other parts of the world. But perhaps more interesting and surprising to us is that it very much challenged the idea of what financial services do when they're digitised. So what we've kind of seen is that because digital financial services are primarily related to payments and remittances, then their primary purpose seems to be connecting people to each other socially and to markets. We have seen relatively little evidence for credit so far because there has been less digitisation of credit products. However, what we have seen is people using it in digital financial services in ways that relate to credit practices, such as taking loan for relatives or paying back a repayment digitally and so on and so forth. So what this suggests to me is that if we want to look at how the digital changes people's practices, actually, we need to focus not so much on the effects of what does this product do to this person, but rather how do people interact in a digital ecosystem in a way that helps them to achieve their financial goals and improve their household well-being. So should I introduce my question already or come back to my question?
I think that you just go ahead and introduce your question.
Okay. So my question, therefore, is then how does that impact the ways we think about financial inclusion if people who are low income, who are the people we normally serve, are moving towards mainstream financial services and using them in a way that it's hard to differentiate, what is a credit practice versus what is a savings practice versus what is a remittance practice?
So this is one question we will be coming back to discuss and comment on later. So I'd like next, for not going in a straight line, I'd like to ask you, Amelia, to start introducing yourself.
Okay, hi everyone. I'm Amelia Greenberg. I'm Deputy Director of the Social Performance Task Force. For those of you who don't know SPTF, we are a nonprofit organization based in the United States. Our primary activity is standard setting. We gather information from stakeholders around the globe about what they've learned about what works and what doesn't work. We identify all these good practices thanks to this collaborative effort, and then we gather it all into a single comprehensive manual saying this is what you need to do if you're a financial service provider in order to protect customers from harm and to create benefits for them. And once we've identified those good practices, then we have a whole suite of other activities where we promote them. So it's all a public good. We do trainings, we raise awareness, we talk to different stakeholders, we have evaluation tools, but the core of it is we are really focused on how to provide financial services responsibly and inclusively, and to avoid the inefficiency of each individual organization having to learn that for their own. If we can just gather this peer learning in a single place, then we can all use this resource. So that's what I do. We've been doing this work now more recently with digital finance, trying to understand the risks and what best practices mitigate those risks. But today I want to talk about the specific aspect of a provider that did not previously have a digital financial service that has started offering digital financial services. And every time I talk about digital financial services, although I see their benefit and their potential, I think I always come off as very negative. So let's just start by saying there is potential and benefit, but you can do it wrong. And one of the common wrong ways is to digitize just for the sake of digitizing without really reflecting on what problem am I solving. And so I often hope that organizations are a little bit more patient thinking about, am I doing this because everybody else in my market is doing this, or am I doing this because my customers really need this? And it's not about the technology, it's about the service. So are they waiting too long to get their loan? Is it too hard for them to get access to cash? What is the problem? And then also there's the piece of financial capacity of the customers that you're serving. I think it is dangerous sometimes to put digital finance in the hands of people who can't manage it responsibly. And I also think it's quite dangerous for a financial service provider to push to market a digital product without having the back office protections, especially related to cyber security, in place. So some of the interviews that we did for our standards, specifically around protecting data, were very sobering, where they were saying that organizations are rushing to offer a product without having the system in place to secure customer data. So I'm going to be speaking later this afternoon about the standards that we developed for financial service providers that have a digital offer, all the different practices that they have in place. But I would say, if I were to summarize some of the issues, and apologies to my friends in this room who've heard my stories before, but here's a couple of examples. There was a group that had an informal kind of savings group, and they were rural, and they got connected to a fintech that gave them a digital savings product, and the woman who was in charge of the group got the PIN for the savings product, and she wrote it on a big piece of paper, and she pasted it on her living room wall so she would never forget her PIN. And it's just an instance of a total lack of security. Now all her savings are in that account. And I talked to a different provider who was promoting digital financial services, and there was a woman who was a good client. She was a fish seller, and they wanted to kind of pilot test with her because she was such a reliable client, and she was enthusiastic, but she did not want to learn the technology. So she ended up giving her phone to her son and said, like, anytime I need to transact, you have to do it on my behalf. And unfortunately, family members can sometimes take advantage of a parent. So that's another instance where there was a danger created to the customer. There's another organization that I know of that digitized in a product way that was successful, but they did not have the cybersecurity in place on the back end. They didn't really have the IT staff to do it, and the director asked the board for a budget for cybersecurity. The board thought it was too expensive, and then they got all their data stolen, unfortunately, and it was extremely expensive to correct that, and they had to shut down operations for a while. And then after that, the board was like, okay, yeah, we should really invest, but I have these questions of how ethical is it to put this tool in the hands of customers without making sure that on the back end you're protecting their data, and on the front end they're protecting their information. So that's my question for the room: is should it, as financial service providers, how much responsibility does the financial service provider have to be a little bit patient about bringing its offer to market until it's sure that it has the right systems in place to train its customers on using the financial service responsibly, that the technology is adapted enough to their skill set that they can use it on their own? Have they thought about, if the customer needs a phone to transact, does she share that phone with her entire family? I mean, if you don't think through all those security concerns, if you don't on your back end have the data, should we say then it's unethical for you to already offer a digital product? So that's my question for the room.
Thank you so much, Amelia. And not least, although last, Anne, would you like to share your stories and your background?
Hello all, very happy to be here. I'm Anne-Marie van Swinderen. I work at LIFT, I'm the managing director. LIFT stands for Low Income Financial Transformation. We started off actually as a research company, specializing entirely and focused entirely on financial diaries research. And that's what we definitely still do as well. But since 2018, we also offer businesses and smallholder farmers the actual tool of financial diaries, which for them is basically a bookkeeping, record-keeping tool. And we help the people using it to extract value and information out of it. We like to call this approach data empowerment, has already been proven to be very effective for micro entrepreneurs. And part of this service set is also a loan platform and credit scoring. So from our research and also our practice supporting businesses and farmers, we're learning a lot about people's experiences on digital finance or digitization as such. And obviously, what I just explained, the service we offer with the record keeping, that's also a digitalization approach. I really liked the stories Amelia was telling. I also want to take you to a person in 2017 in Uganda. So she was about 21 years old and sort of living in a small village, nice t-shirt on, very active young lady. And this was the moment when Mocash had just started in Uganda. And Mocash is the equivalent of the M-Shwari. So it's a digital lending which you can just do without actually applying for it anywhere formally. You just apply through your MTN mobile money account. And they give like loans of $5, $10, $15, and in principle you repay in 1 month. And this young person, I mean, this was literally 4 weeks after the whole Mocash was launched. And she was telling me how she really, really wanted to take a loan from Mocash. And she was already, she had already decided that she would be eligible if she would buy credit, phone minutes regularly. So she was trying to buy every week the same amount. She decided that she started her first phone call at 6 o'clock in the morning, because then the Mocash people would know that she's an early riser and she's a hard worker. And she was deciding on all these kind of behaviors that she thought would help them give her more loan on Mocash. And I don't know what the algorithm is of Mocash, but I thought she probably was quite right with some of her behavior. And I find it fascinating how fast somebody in an environment that wasn't particularly educated had this clear vision of how digital finance works. And I also have an example from Colombia where somebody on purpose got a credit card from a supermarket and was like buying in that supermarket where she would normally not buy, and she was then all the time paying back exactly a day before the money was due every month, and she was just super focused on this credit card, behaving very well, because she wanted a loan for repairing her house, which is sort of very long-term perspective, and I also thought very sophisticated. So that is, on the one hand, I think a lot of people in in the policy-making side, think of, oh, these poor, vulnerable farmers, they haven't got an idea, and we are just deciding for them or something. People are actually very sophisticated in the way they think of money in general and also digital. But on the other hand, this is almost a reverse argument, is that you see so many digital apps and farming apps, and there's a lot of very nicely designed, intuitive, customer-centrically designed services, and a lot of them fail. If you would make a list of all the big fintechs of 2018 and how many of them are still around, of the apps that were designed around that time. And I think the failure is not even in the way it was designed, people doing exactly the customer-centric route, etc. But it is not enough to design a nice app. What is the problem is that sort of if it is a really good app, you expect people to just go grab it and use it, and that they will tell their neighbors, and that everything will go by itself, spreading. And so what we are doing with our app might not be as slick and as attractive or beautiful, but we've put a lot of effort into explaining how to use it and working with people, showing for each individual what's the benefit to you and how can you make sense of it. So some people, when they want to engage us, they think they just buy a technology, but we have some cost of the coaching at the beginning. Sorry, it might be too long. Anyway, so high tech, high touch. Then very briefly, there's so much push of digital payments. Somehow I think donors really like payments, and they all talk about that payments will solve things. A lot of people we've spoken to think cash is fine for payments. It's the savings or being able to reserve something or getting credit that they want the digital feature for. Yeah, I've got my questions around the payments. What, for me, is the conclusion is that at the moment still we're in this honeymoon phase. We have a certain naive adoration of digital inclusion, digitization, blah, blah, blah. We need to just grow up and be realistic about it. So almost get out, like microfinance first had this aura around it, and just having anecdotes of it going well was enough to prove that it was useful. I think for digital also we have to leave all the naivety behind and look at it and see its shadow sides, see that it can do some things, but it is very, very hard work.
So your question is on how best to design something that's actually useful and solving a problem.
Yeah.
Yeah. Thank you so much. And I think that we now have questions that are quite broad, which will allow you to participate and share your comments in this section. And I think if I summarize them, not as broadly as they were put, but if we start with the fact that we're sometimes underestimating people, that we think of them as needing to be more financially literate, but in reality, they're really smart about how they manage things. That's what we usually see when we go and talk to them. And we'd love to hear your examples on that side and how that relates to Anne-Marie's comments. And then to go back to the institutions and hear about Amelia's experiences of what it also means to put out new digital models where we have to actually understand how they can help people, but also to do that in a secure way, and then come back to the more provocative question from Erin to say, is that really something that traditional finance is going to do even better than the specialized institution, to put it nicely, if that works for you? So I'd like to share the mic with anybody who'd like to share their experience first of how customers are accepting digital. Who wants to go first? You want to go first.
Yeah, thank you so much. I am Sulaiman Katende from Uganda, Pride Microfinance. I just wanted to share our experience in Uganda. The uptake of digital is quite high, especially from MTN and Airtel. And a number of these people that access, they are actually smart. They are the formal people down there, but they get to know the tweaks around. I think word moves like fire. Whoever does it knows how to beat the system. They are going to tell the next and the next. Before you know it, the entire place knows how to do it. And how we are seeing this is sometimes you are sending money to one of the guys out there, and then the guy is like, no, don't put on that line. We tend to have several lines, mobile lines. So sometimes, don't put on that line, please. I have this other line. So they have two lines. One is for borrowing. So if I'm not ready to pay now, don't put the money there, please. And then the next line is for the normal transactions or even receiving money. So that's why that's what we are seeing, and the portfolio at risk, the repayments are not so good with those banks that are dealing with the MNOs. Thank you.
Thank you so much. I'm sure there must be more stories. Who wants to share the next story? Did you have a comment? I saw you nodding before when Anne-Marie was talking about people being street smart.
Yeah, but it's not so much stories. It goes a lot in the direction that we just heard, indeed, about the street smartness. I think more a notion, a caution a little bit to what Anne-Marie was also saying, that not to let ourselves be overtaken by the promise of digital only. Earlier when we were talking about young entrepreneurs, one of the things that jumped at us from the research is really the most digitally savvy generation we've ever seen. And nonetheless, they very much still care about having a guiding hand, a face in the crowd, so to say, someone to rely on, because finance carries a lot of mystique, and digital is good for some things, but it's very bad at cutting through those worries and concerns that relate to this mystique. So the old, I think from what I remember when starting out in finance, everyone was talking about omni-channel. I think we're still there, and that still is a big part of the solution, that we don't throw out the physical and human baby with the bathwater. The other aspect, I think, that we've seen a lot has to do with your ability to make the business case of certain clients and upsell and cross-sell. Digital doesn't do a good job at that. And this kind of, I think, this classical meme of Alec Baldwin and always be closing, digital is not good at always being closing. Our loan officers, our sales staff is much better for that. And the privilege as financial institutions of having these relationships of trust and occasional human interactions is something that is really very, very valuable, and we should try to stick to.
Thank you. This is exactly what we like.
Yes. Yeah, I am Ruhidas from Bangladesh. Our organization name is Bastop. Really, we started digitalization of our microfinance program. Then the software company, they gave the software and said, you continue both computer and manual. So after a few days, the staff said, no, we cannot do it. Now our work is double. We are maintaining manual and also software. And very often it did not work. So twice we had to change the software. And the third one, that was better. But still the problem is, as MFI, we are getting benefit. But for the people, they are not in a position to utilize, only they get the data immediately. If they call, how much balance I have, how much deposit I have, that we can say immediately, but they do not have still the access in the software. They cannot enter there and they cannot know the data by themselves. So still the system is not there. In Bangladesh, I think every software, it did not happen again. It needs some time, some more time to use this modern technique that the client can enter in their account and know their data. So I think it will still take time, not in a position now. But it is running. For our MFI, it is okay. But for the client, not yet.
Thank you. Good comments about clients and also about the young people having difficulty understanding the underlying structures when they're used to having everything delivered digitally. We see that in the Nordic countries where I come from as well. I'd like to ask whether perhaps Amelia or Erin would like to comment on this as well.
Yeah, I can say I do think there's a nice message coming out of all this, which is customers are so very different. And so you have the ones that are super digitally savvy, and the danger is they'll over-indebt themselves because they've really figured out how to game the system. Or the danger to you is they'll figure out how not to have to pay back their loan until they really want to because they have multiple, and then there's the other side of someone who's not really ready for this and has access and it's not safe for them. One of the other aspects your comment just made me think of with the software that's sort of working but not quite the way you want is also the side of your staff themselves, and we haven't talked about that yet, but another challenge can be if you are digitizing, the process of that change can sometimes be underestimated how challenging that is for your organization and particularly for your staff. So we heard examples of staff that were proud that they were entrusted with cash because it's a safety issue, and they didn't want, or staff that didn't want to learn new technology or that were threatened by it. And in some cases, people's jobs do change because technology replaces what they used to do and they have to kind of shift functions. So that's another just aspect that I would throw to the room in case you guys have examples. But certainly everything you said resonated with what we've heard too.
I have a question. You're putting a lot of focus on the difficulties to get the people to use it properly, but at the end of the day, when microfinance started, it was the same with consumer credit, and we know that half of the supposed to be income-generating activities were actually consumer credit. And so there was a whole issue of explaining to people how to manage a credit and so on and so forth. So the issue here, I think, is to know, okay, so that requires effort, that requires staff, that generate cost. But the promise of digitalization was to say that it would reduce transaction costs for the consumer, get more flexible, and reduce operational costs for the microfinance institution, ultimately resulting in lower interest rate. I mean, the supposed to be big advantage of digitalization is reduction of operational cost, translating into cheaper credit for the credit size I'm talking about. I mean, out of what you have been looking, do we see this somewhere or you don't see it? Because I have the impression that this was the starting debate when it started. And then we're moving to many different things, and I have no opposition to what we're saying today. I'm just saying I'm quite amazed of how the debate has kind of lost the initial issue about digitalization, which was we're going to make an effort, but it's going to result into cheaper product.
I think, you want to answer the question, or?
Yes.
Yeah.
Yeah, thanks. Yeah, thank you. That's a really good question. There are many ways to answer it. So from the research we're doing, because we're focusing so much on payments and remittances, because that's what people are using, absolutely the biggest benefit is transaction costs, for sure, especially saving people time travelling, especially people who live in rural areas to get to and from places. That's mostly in relation to payments and remittances. In terms of the evidence that's been published from academia, there's so little on credit. We've actually written a paper summing up the evidence that does exist, but we're not at all clear. There is nowhere near enough evidence to say what's happening with reducing fees. Practitioners might know the answer, but it hasn't been published yet as research.
I would just add to that to say and we are not a research firm, so believe Erin first, but our anecdotal impression is that prices are not coming down, and that the major benefit of digital is the convenience. So certainly the ability to transact without having to travel somewhere is how a lot of digital providers are describing the benefit, that it's safer, and in some ways it certainly is when you're not handling cash, and that it's much faster. I mean, you can apply for a loan and get access to it in minutes instead of weeks. But the cost is not coming down. And when you talk to the digital financial service providers, the technology, first of all, there's some errors. I think people have invested in technology that didn't quite suit them because they didn't know how to select technology that was appropriate, and invested, and then they kind of get stuck. They've spent too much to do something else, but it never was quite the right fit. But even the idea that you would digitize and then you get there and then you don't have to spend that money anymore is wrong. There's a constant evolution of technology. So the cost is enormous, and I am sympathetic to that. I mean, any of the small microfinance institutions that's trying to digitize has at least $500,000 worth of cost, and so that they, who's going to pay for that if you don't have a donor or an angel investor or something? So I think there's a significant, but the other big problem is if you're going to do credit lending without the traditional assessment of capacity to repay, you really risk having worse loan portfolio quality, and that cost also gets passed on to the customer typically. So no, we don't see prices coming down. And even if people were more responsible in the lending, I'm not sure I know the answer to whether it's realistic given the cost of technology, the ongoing cost. And as an example of ongoing cost, one of the big problems is fraud, right? And fraud gets increasingly sophisticated. So organizations need to be increasingly sophisticated in their response, and they're right to do that. But it is an investment. If you find something that works and then your cyber criminals develop something new tomorrow, you have to stay on top of it. So I do think there are some both valid and invalid reasons why prices aren't coming down. But anecdotally, we are not seeing that big drop. But we are seeing the efficiency, as Erin said. Certainly the people, if you ask them, is it more convenient for me to use this digital payments or to apply, for the loan online versus having to go stand in line at a place that's 4 hours away? There is the benefit of that.
Thank you. I'd like to ask if there's anybody who wants to share stories about the customer benefits or customer reception of digital solutions based on the question that Anne-Marie raised, or whether this is a good moment to take the next step forward and have a discussion on whether the companies are moving into this space too fast or too slow. It could be both, based on discussions that we are having and the fact that they're not achieving the goal. But anybody want to share a customer story before we move on? Otherwise, we will come back to it. There's one all the way at the back.
Thank you. Can you hear me? Yes? Okay. Hi. So I'm Davide Castellani, University of Bergamo. I have the chance to, analyze a large quantity of data about the usage of digital financial services. And, most of the time we say, okay, for example, if you look at the experience of Kenya now, 90% of people, they have a digital financial account. We consider them as included. But then if you really look at the frequency of usage of those accounts, I mean, you realize that still close to 50% of the people are really excluded. So most of these digital accounts are not used. So my comment is more about the value proposition of digital financial services and how we can increase usage of digital financial services. Because even the statistics, they are biased, in my opinion. So we still need to look, how what's the value and if they are really used by people. So.
Thank you, Davide. That's a really great comment/question. Yeah, the question is, why do we want people to use digital financial service? Does everybody need to use digital financial services? And in some places it can be extremely helpful, such as, for example, in rural Laos, where we're doing research, we're finding that people are starting to uptake bank-based digital financial services really, really fast. And elderly or older people are learning from their children who are uptaking them. And sometimes it's not everyone, it might be one member of a household. But that effectively means that everybody has access in some way. But in Cambodia, where we're also doing research, we're finding that uptake is slower, even though this is opposite to what was predicted by the body who funded our research, who said that, well, we don't even see the point of you doing research in Laos because nothing's happening. Everything's happening in Cambodia, and we found the opposite. But the reason why it's not happening in Cambodia is because they have a very, very functional over-the-counter service where people take cash and pay. They don't need a digital wallet, so they have something that works. So it's very context-specific, depends on what's already happening in the country and what people need. So yeah, there are places where people are functioning perfectly in cash, and there's not really a whole lot of point to push them to do something else unless a real use case does come up. And we must remember that when people are working in a cash system, it doesn't make sense for one person to switch to digital. What would be the point of a woman who sells in a market getting cash and depositing it in the bank, only have to withdraw it again to pay the wholesaler, So people live in a system that makes logical sense to them.
Hello?
I think related to what you just commented, we've seen in different countries really different use cases. With Colombia, for instance, one of the most striking use case was the security, traveling with money safely without anybody seeing it. In some other countries, you see women having the use case that their relatives don't know that there's money there. And Kenya has been maybe an exception. It's almost the first country of mobile money, and that seemed to be sending money over a distance, which might have just been a fluke in history of Kenya that came out at the moment when there was a lot of need for sending money over distance, and you don't see that repeated in other countries. Most striking from research in Ethiopia was that people didn't find, they found it very, very expensive. If they would save time and travel cost of a bus even, the cost, just the upfront cost of the percentage of the mobile money was unacceptable for people, and they would rather spend it on the bus fare. There we only found the use case of in cases of farmers, that they could get access to high quality seeds and then repay those seeds on credit digitally, then digital would be interesting. So maybe you could almost say that in Ethiopia we didn't find a use case. So I think, yeah, in some countries maybe you just have to shrug your shoulders and say, there's nothing so wrong with what's there.
I think we have a comment down the back, but it's very interesting to see the fact that if you don't solve a problem, you're not relevant, even if you're digital.
Yes, hello. My name is Joëlle Azoumé. I'm from Orange Money Group. So I think many comments have been made already, but most of the mobile network operators have statistics on active accounts. So you may find that some accounts are not active just because some are used as savings accounts. They just keep the money. You related to women who wanted to keep money on their wallet just to save their money, and so they're not active and they're not in the statistics. Some use it for international remittance or other things. So this, and I agree on the fact that each user has a different perspective, different needs, and so we should focus on what is useful.
That makes totally sense. Anybody else wants to comment? Yeah, I see that.
Yes, I'm Mehdi from Congo, and I'm working in the academic service. I just to share with you an experience from a study we did in Congo on mobile money. And we regard just the constraint people are facing when they use mobile money. And from a mixed method study, we identified three constraints: a lack of transparency, a lack of knowledge, and a lack of network in terms of connection. And this is a most tailored difficult or problems because mobile money sometimes use French language, and most people are speaking local one, and they cannot understand well what it is demanding. And now what we did also, it was to connect the true barriers to the attitude and the willingness to use in the future. And we saw with from the research that the lack of transparency is not a matter for people, because they said we cannot have many information from what mobile money can get us. We have now to buy mobile money service as a tenants service because we cannot have many information, and this is we found in this research.
One down there, and I'll come to you.
I thought you said. Sorry, yeah, so Stephanie from BBVA Microfinance Foundation. So just to go back to some of the reflections, I would say three: back end, front end, and ecosystem. So on the back end, why we are unable to decrease costs is because we're oversimplifying this quite a bit. So the first thing is, it's very hard to give a digital loan to a person for the first time because you don't have any information of that person. Generally, it's going to be a physical process for starters. When you renew a loan and you do it digitally, let's say that you're able to do it for 20% of your portfolio, that does not allow you to decrease costs so significantly, not only to the technology process, but just because of all the processes that are involved and the information that you're able to gather. Second, in addition to fraud and all the other examples that we mentioned, there are a lot of things about the information you gather from the client that when you do it digitally, the information gets significantly worse. The quality of the information you report is really bad. I mean, we're talking about, again, depending on the client that you're serving, we're talking about very vulnerable people that generally do not even know how to sign their name. So I think that when you look at fintech, for example, and you see how they've been advancing in some countries, they generally have a couple of items, and that goes to the front end. And let me just go back to the front end a bit. People that on the front tend to use digital services are people that are more educated and or they leverage, again, family members. But it's very hard to start using very good, healthy digital financial services for people that, A, do not have access to the internet on a stable basis, B, do not know how to use those services. So let's say, in our case, in Latin America, 53% of our clients which is half of our 2 million portfolio clients in credit, are digitally poor, which means that they do not have access to the internet, they do not have a stable connection for the entire month, they do not have any knowledge of financial service, digital services in general. They just use the WhatsApp in best case. So how would they be able to use a financial service to start off with? And going on to the front, even if we provide training, which we do, it's very hard to break certain barriers. If we, for example, have a hard time, we're all digitally literate, if we have a hard time switching from Microsoft to Apple, and there's no clear case to do that change, why would a client of ours do that? I think we're making certain assumptions that are too straightforward and not evident at all. And then going to the ecosystem, and then we can have a broader discussion which is slightly more complex, they're pushed by the entire ecosystem to do digital services for a number of reasons, and that's why it's very important to look at the entire country and the entire financial system, because that will condition and trigger a lot of the behaviors that we have to do. To your point earlier, Aaron, right? If I have to do everything in cash, why would I use a digital service? It doesn't make any sense at all. So it's a lot about how the ecosystem is moving, not only the digital ecosystem, the telcos, but also the financial system and the drivers behind those and the cost process behind those that are much more relevant to this conversation than what FSPs ever do. And that's why most FSPs just digitalize their backend, because you want to become more efficient in serving more clients. But you have no incentive, if not negative incentives, to actually digitize your clients, because the cost, the risk, the fraud, all of that you mentioned, but also the incentives of the clients are not there at all. And you can see it when you look at Nubank in Brazil, right? So where all the barriers have been lost, like in Brazil, Pix is working great. If you look at financial inclusion and you're honest about it and you're looking at progress, you can get a lot of question marks.
Great, thank you very much. Well, I think we'll take the comment here up front before we move to any comments from you up here.
Hello. Okay, I have two comments. When we started our digital agenda or digital transformation, we wanted to digitalize women in communities. And what we did, we got a grant, bought 2,000 mobile phones, taught the women how to use them, and they were integrated into the mobile money and onto their accounts in the banks. Unfortunately, there were fights in their homes. The men took away the phones, and the majority of the women ended up selling the phones. So we saw that they still needed that cash or face-to-face transactions. But again, we didn't give up. That was 7 years ago. So we said, no, let us insist and see if it really works. And what we have noted, that the transactions that come through, or it is cheaper for us, on average, a face-to-face transaction costs us average 2.8 euros. But when it is digital, it is 41 cents. So looking at the efficiency and the cost effectiveness that we as an entity get, we are trying our level best to push our customers into the digital platforms, whether it is agent banking, ATMs, mobile phone banking, and so on. But the journey has not been that strong. We set a target that by end of this year, 60% of our transactions should be digital. But we are at 42%. So it is a journey, but when it is intentional and the customers see the benefits, especially the time, you know, time is the most expensive resource. When they appreciate that, then you can be on board with that digital transformation journey. Thank you.
Thank you, and very interesting to hear about cost savings, which is leading perhaps to combine the comment from you and also from Stephanie earlier on, or that relates to Amelia's question about whether we're launching too quickly or not. So anyone who wants to comment, or perhaps Amelia want to add to?
I was thinking about what Stephanie was saying about the ecosystem pushing you to do something that you don't want to do. And I was thinking how in my personal life, I've resisted giving my own child an internet-enabled phone. And now the school system is doing education that requires you to have apps on your phone. And so I'm forced to buy him a stupid phone, even though I don't want to. So I want to validate that, yes, I can see that in a lot of contexts you might not have a choice. I do think pro-digital, when we talk just about back end, I think it's a much clearer case for doing it. I mean, having data in binders on paper is a fire hazard, and it's super inefficient, and you cannot analyze. I mean, one of the big powers of data is to analyze it from decision making. So I don't find the back end discussion as controversial, but I do validate the front end, all the difficulties, and in the example from our friends at Pride, I think the effect on the household is a big question in digital, not just if you've given a woman a phone for the first time and then her spouse wants it instead, but also if she shares her phone, even if she already had a phone, and you're starting to put private financial data on a phone that other people can see, you have to think about it. So I was interested in that example too. Certainly, as we talk about tech and touch with digital, I think there are some challenges to some of the approaches that maybe weren't immediately obvious to the financial service providers that might have been if they'd asked their customers, like, what, if we offered this product, but you needed to do this phone or get to this place or use this agent, what would your reaction be? Whether it's founded in reality or not, you would really surface a lot of sort of any kind of mistrust issues, and you might have learned something about the household that would make you redesign a little bit your offer. But I also, when Stephanie was talking about the cost being prohibitive in some places, it's certainly, I think, a valid observation as well.
So anybody else wants to comment on the efficiency and the risks that are related to introducing digital solutions with financial service providers? Because that was sort of your original provocation. Are we rushing into things sometimes, or are we just moving and learning on the journey that we're taking forward? If not, if you don't want to comment on this one exactly now, I was wondering if we should perhaps turn to Erin's starting question, whether there's a difference between microfinance institutions and general financial institutions, and add to that, I think that we have seen examples that go across institutions now. So how do you feel about your question?
Yeah, I think I might just try to simplify the question and break it down a little bit. So first, is the future of financial inclusion actually digital? To what extent is that going to happen versus having a hybrid system, and what is the time frame for this? And second, is the future of financial inclusion actually mainstream, with mainstream companies like mobile money operators and wallet operators, banks and so on, offering things rather than companies that have a specific mission to serve low-income people?
Yeah, nice.
Thanks. So I'm Jade. I'm from a company called Jumo, and we do financial inclusion and also partner with mobile network operators and banks to offer loans and savings products to emerging markets. So it's an interesting question, and it's almost like we've bridged that gap. So our mandate is definitely financial inclusion. But we look at things, obviously profitability, portfolio, health, etc. as well. But on the point of reducing price and efficiencies, etc., we really have found that technology does help that. So since inception, we've reduced our cost to customer by 47%, but also made a very conscious decision to actually not reduce the cost further, but help financial inclusion. So you've got two trade-offs. You can drop your price to your customer, or you can push financial inclusion much further. And that's where we're going right now. And a lot of conversations around how ready customers are, and it's a very real challenge that we have, where a lot of our customers, it's for the first time that they have never used financial services. 38% of our customers actually record that they've never ever had a loan product before. So part of that trade-off between dropping the price and also going further into the base is how do you protect customers? And we've got an ethos that really looks at that and goes, if we get it wrong and the customer doesn't repay, it's on us, it's not on them. So it's just, I think a mindset that is very important to have. But also, I do believe that, what we do, which is working with mobile network operators, is the best solution. So we don't try and bridge that gap ourselves. We have strong partnerships which actually have access to millions of people, and that's how we are finding that it's working quite well.
So as a partner, future partner of Jumo, we're a mobile network operator. And so if I give the example of a bank that we opened in Côte d'Ivoire, 1 out of 2 bank accounts were opened with Orange Bank and with microcredit loans. So it's a huge step in volume towards financial inclusion. Considering the costs, maybe there's another actor that we didn't mention, especially in sub-Saharan Africa. It's the regulator that sometimes increases taxes on financial services. And that's to be taken into account also in the cost.
Anybody else want to comment on cost and efficiency in the digital solution? Because I hear cost, and it's great to see that costs are coming down, but is that at the rise of risk and losses through that? Or anyone wants to comment on security or security breaches? Great.
Okay, I can give it a shot, and this way the entire next panel will have spoken. So I'm Antoine from CGAP. It's more of a question or intuition on this question of cost that we haven't raised here, because we are comparing microfinance and like the well-known old microfinance model and what digital providers do. And I'm seriously wondering, can we actually compare them? Because I'm not sure that any digital lender has been able so far to reach the kind of loan amounts than typical microfinance institutions do. So when it comes to analyzing the cost, of course, the nominal cost is going to be lower, but you're going to compare it to a loan amount that's also much smaller. So if you turn this into an interest rate, it's still going to be very expensive, but it's a product that has nothing to do with the other one. So I'm really curious to hear what people think about this.
People don't think anything anymore. I think we've come to a point where perhaps people are getting tired, and that's perfectly reasonable, which means that it's perhaps also time to sum up a little bit on what we have discussed, and I'll just be doing a brief 3/4 of an hour on that, so that you have a nice nap before ending. No, I'll just say that we have discussed uses and access, which is really important, and we have discussed that competition between different organizations is coming round, and it gets more difficult to distinguish between them. We've also discussed that digital is not so very easy, neither to introduce nor to do securely and at low cost, as following up on the promises that digital seemed to have when it was first introduced. And then I keep coming back to an old study that I did perhaps in 2010-12 that came up with the fascinating result that people on the beneficiary side, on the customer side, they want control over the economics, they want value, so they want the cost reduction, and they want convenience, and of course they would like to say they want security as well. So that sort of keeps coming through every time we have this discussion. And then I'd like to invite my 3 presenters up here to add their comments to that, and with that, I think it concludes the session.
Yeah, thanks a lot. There's certainly an interesting range of outputs from this discussion. I'm quite happy with what we've come up with because one of my personal goals for this session was to really just get a sense of how people are thinking about this issue, so it's been super helpful. I would just like to actually introduce a new topic very quickly, sorry, which has been briefly discussed, but it's the question of gender, because one of the original promises of microcredit, going back several decades, was to assist women particularly and then assist them to assist their families. So far in the literature, the academic literature, we're seeing mostly positive impacts on gender. I don't know what practitioners are seeing in the field. That's a different question. The academic literature is still fairly small, so you don't want to just go, oh, well, definitely, you know, we're seeing such great results, but it is looking positive at the moment. I hope that as time goes on, we can collect more evidence and get a clearer picture. But I would like to issue a caveat which relates back to the comment of the lady over there on gender, which is that gender can only be an area in which there are positive impacts if we're talking about locations where women do have some sort of degree of agency and freedom. So there's always like a serious constraint. It's not like digital finance can all of a sudden liberate women everywhere. You know, there has to be some kind of agency to begin with. But nonetheless, there is some hope there. So I think that I'll just leave it at that.
Thank you.
I was reminded, as I was thinking about sort of the pros and cons, I was reminded of someone I was talking to who she had made a payment, a digital payment, and like a utility payment, and she'd gotten a receipt saying you made this payment via SMS, and she kept the SMS message for a month or two, and then she deleted it, and then after that, the company said to her, you never paid your bill. And she didn't have her receipt anymore because she hadn't saved her SMS message indefinitely. And she was really frustrated, and she ended up repaying her utility bill, but she wasn't going to stop using digital payments. And I think that's actually kind of indicative of how I feel and how many people, like how many of us have had some sort of frustration. I think it's quite common, and yet we aren't going to stop using it because of the convenience. So I really think this discussion is timely because, you know, all of our focus is the customer protection. Like this is a channel that does help people get access for the first time or get more convenient access, but at the same time there are these risks that are really rampant, and so it's incumbent on all of us to solve those problems. But the solution isn't, you know, we're just going to live in an analog world. Some people do and some people don't, but we do need to find a solution, because even when people encounter challenges with digital, they're continuing to use it. So I find it quite urgent to figure out how to make it safer for them. That's my closing thought.
And the issue I keep on struggling with, and the session hasn't solved it, is this thing about scale and the need to scale. And I mean, normally for almost any kind of intervention, beforehand you don't know really where you're going to, and with digital finance you have the same. And there are many big surprises where some kind of outfits really seem to have been exact fit with the population, and they suddenly have overnight tens of millions of users, but it's very hard to predict. And that, you know, where normally you would want to sort of experiment and try out things and sort of learn as you get along, you can't do that with digital finance. It's far too expensive to set it up. And without actually the thing working, it's really hard to trial it out. So yeah, I haven't got an answer to this, at least something to consider.
Thank you so much. Good comments, and also a good question being raised here at the last minute. So a discussion to be continued, I hope, over time, over network. And I'd like you to thank yourself and to thank the discussants up here, and also remind you to stay for the next sessions, which are going to be equally great. So thank you very much. Thank you.